So quickly, I'll talk about a little bit about the firm. We are a full-service CPA and advisory firm established in 1963. In addition to traditional tax and audit services, we provide outsourced CFO and controller services, third-party administration for retirement plans, QuickBooks, and other accounting software setup and training, and more. We have 26 partners and 165 additional team members. We operate from 6 regional offices in Pennsylvania and Maryland, and you can learn a lot more about us at sek.com. And our presenters today will be Nat Fissel. He is a member of the firm in our Hanover office. He also serves as the firm's tax director. He joined SEK in 2004, more than 20 years of experience in public accounting, and he works with closely held businesses, primarily in construction, manufacturing, and professional service industries, as well as working with high net worth individuals. Our next presenter is Kelly Chambers. She is a manager in our Hanover office. She joined SEK in 2025, earlier this year. She has more than 30 years of experience in public accounting. She works with closely held businesses and their owners, primarily across small to mid-sized multi-state operations, and she's proficient in QuickBooks and Peachtree. Our last presenter is Nick Chapman. He's a supervisor in our Hagerstown office. He joined the firm in 2022. He provides tax planning and preparation services and outsourced CFO solutions to clients, and he primarily works with closely held businesses and individual tax clients. So a huge thank you to our 3 presenters, as well as everyone for joining us this morning. And I think that's all I have. I'll let you take it away.
Righty, so we have a pretty full agenda for you for the next hour. We're going to start with some individual tax changes with the One Big Beautiful Bill. Also go through some planning considerations for individuals, and then we're going to wrap up the day with a discussion about some of the changes for business taxpayers, and then some tips, general tips for business owners. So the One Big Beautiful Bill Act was passed pretty significantly on July 4th of the current year. It's probably the largest piece of legislation around tax law since the Tax Cuts and Jobs Act that happened in 2017. And really, this bill, the primary focus was to avoid the cliff because all of those provisions that were established in 2017 were set to sunset at the end of this year. And there is a possibility, there's been talk of a second bill to kind of wrap up some of the things that didn't get accomplished in the first bill. Of course, now in December, it's probably unlikely that it's going to get passed before the end of the year. But that is something to consider that might be coming down the pipeline. One of the first items that they made permanent from the Tax Cuts and Jobs Act is the increased rate categories. And by increased, I mean the amount of income that is between each rate. Previously, the top rate for individuals was 39.6%. The top rate in these brackets that have been established since 2017 is 37%. And just to give you an idea, if you were merely filing jointly in 2017, you would hit the top tax rate at about $470,000 of income. So these rates now, you're in the top rate only over $750,000. It's quite an increase in the amount of rate that you're able to have. Another item is the alternative minimum tax. Prior to the Tax Cuts and Jobs Act, about 3% of American taxpayers were subject to this alternative minimum tax. Now, after this, and it's now been made permanent, the extension of these exemptions, only about 0.1% of people are going to face this deduction. So it's not very common anymore. Another thing that they did was implement and make permanent the mortgage interest deduction calculation, which limits the interest that is deductible up to $750,000 of indebtedness. And also, you're going to be able to include your PMI payments in that amount. The important thing to note is that mortgage interest is based on not what the source of the interest is, but the use. So if you take out a home equity line of credit, yes, the line of credit might be secured against your home. If you go to buy a boat, of course, that's not going to be deductible as mortgage interest in that way. Additionally, the limit on personal casualty losses is extended. So you're only going to be able to deduct casualty losses that are in a federally declared disaster zone, and now expanded if a state declares a disaster starting in 2026. This is how you're going to be able to claim um, casualty losses. No longer are you going to be able to claim them for personal losses like fire, theft, or vandalism that aren't within these declared disaster zones. Another provision would be the limit on excess business losses. It's going to reset in 2026 to be $250,000 for individuals and $500,000 for married filing joint taxpayers. This is your overall limit on business losses. So it's something to keep in mind if you have other categories of income, such as capital gains from non-business sources, not necessarily going to be included in this calculation. So that is something that can use some planning if you seem to have that scenario. Another item that is going to be made permanent is the elimination of the moving expense deduction. That is only going to be available now for active U.S. military personnel. And starting in 2026, there also will be deductions allowed for certain members of the intelligence community. The standard deduction is staying around in its increased form. For 2025, we're looking at a standard deduction if you're married filing joint of $31,500. If you look back in time, we were headed toward going back to using personal exemptions. And in that category, we probably would have been looking at about a $12,000 deduction. So the extension of the standard deduction really gave you an increase uh, compared to where we were headed. Keep in mind, additionally, for people who are over 65 or blind taxpayers, there is an additional standard deduction on top of that amount. The child tax credit has been made permanent and increased to $2,200 per child. Up to $1,700 of that is going to be refundable. Remember also that even if you're not eligible for the child tax credit, there is a $500 credit for dependents who are not a qualifying child. And new for 2025, to keep in mind, taxpayers must provide a Social Security number to claim the child tax credit. The adoption credit has also been expanded. Now you're able to take up to $17,000, $280 credit. And starting in 2025, up to $5,000 of that credit is going to be refundable. Keep in mind that this covers costs such as court costs, travel, legal fees, any of those costs that are considered with an eligible adoption. 529 plans, contributions, you're going to be able to contribute up to $19,000 per donor to each beneficiary. That means if you have a married couple, you're going to be able to contribute double that, 38,000. You're also able to front load these contributions. If you want to make up to 5 years at once, you can do that, and you can see the amounts that are there. The only caveat would be, since you're front loading, you're not going to be able to give those amounts for the next 5 years to those beneficiaries. Historically, 529 plans have been able to be used for higher education, tuition fees, books, as well as K through 12 education, up to $10,000 per student. Now, with this expanded bill, you will be able to use, if you have a 529 plan that's been open for more than 15 years, you will be able to roll some of that into a Roth plan, an IRA, up to $35,000 for your lifetime limit. But keep in mind that your annual contribution is still going to count there. And after July 4th, the date of the passing of this bill, additionally, in addition to the higher education credits or the higher education costs, you're going to be able to use that for post-secondary credentialing, licensing, continuing education, think trade schools, CPA exam, things like that. Additionally, for K through 12 expenses, that limit's now going to go from $10,000 to $20,000. In addition to all those provisions I've already discussed, we also have Trump accounts that have come into play as the passage of this law. And this is going to be eligible for anybody that is under the age of 18 who's a U.S. citizen. The government is going to provide $1,000 for anyone that is born between 2025 and 2028. And starting with people born in 2025, the government is going to automatically open these accounts. We're still waiting for some more guidance exactly how all of this is going to roll out, but no contributions are going to be allowed before July 4th of 2026. So not something that we have to worry about real pressing here. There's an option to contribute up to $5,000. Half of that, 2,500, is eligible to come from an employer, and the monies will be invested and can be converted to an IRA when the child turns 18. Between 25 and 30, you can withdraw the full balance for post-secondary education, credentialing programs, or the possibility of a down payment on a home. And after age 30, the full funds can be withdrawn. Just keep in mind that any deferred portion that is in these accounts is going to be subject to regular tax rates whenever it's withdrawn. Now I'll turn it over to Kelly to discuss some more changes.
Thanks, Nick. So with the campaigning, there were lots of promises that were made, and some of them are fulfilled with this tax bill. So one of them was raising the SALT cap. It used to be $10,000, and it's temporarily raised to $40,000 for single, married, filing joint, and head of household, starting in 2025, and $20,000 if you're married filing separately. It does start to phase out at $500,000 and $250,000 for married filing separate. The phase out is 30% of every dollar you're over the modified adjusted gross income. Both the $40,000 cap and the $500,000 phase out threshold are going to be increased each year by 1% through 2029, but it will never go below the floor of the $10,000. Unfortunately, it reverts back to $10,000 in 2030. And in order to take this deduction, you do have to itemize. So a quick example, a married filing joint couple has $550,000 of income. They're $50,000 over that threshold, so they only get to take portion of the SALT deduction. So $15,000 is limited. So instead of taking $40,000, they're only allowed to take $25,000 for the SALT deduction. Another one of the campaign promises was no tax on tips. This is effective only for 25 through 28, and it's for tips that are paid to eligible employees and self-employed individuals. Unfortunately, those that are in the specified service, trade, or business, which we commonly call SSTBs, are not eligible. Those businesses are ones where the primary income is coming from the reputation or the skill of the owner. So things such as endorsements, licensing, appearance fees would make an SSTB. Other examples are the healthcare industry, law, accounting, performing arts, and consulting. So tips that are going to qualify for this credit are ones that you had to have been getting a credit or had to have been getting a tip for previously. So you can't just change your industry type to now all of a sudden start receiving tips. The IRS just put out a list of qualified occupations, and there's a special code for each occupation, which will have to go on the W-2 to verify that you're able to take the tip deduction. So the tips that qualify are voluntary cash and charge tips that are received from customers or that you get through tip sharing. Unfortunately, when you see those automatic service fees that are on bills or the automatic gratuities where the customer doesn't get to control the amount, they are not going to be eligible. So I foresee that there's going to be some pressure put on businesses in order to change those policies so that the employees are able to take this deduction. The tips will end up being reported on the W-2s, 1099s, or a separate statement that includes the occupation. It's a maximum of $25,000 annually that you get to take for this tip deduction, but it's limited by the tips that you receive. So if you only make $20,000 in tips, you only get a $20,000 deduction. For self-employed individuals, the limit is the same. So if you only make $20,000 from your business, you can only take $25,000 worth of deductions. It does phase out at $150,000, $300,000 for joint filers. This credit or this deduction is available whether you itemize or whether you take the standard deduction. And one of the caveats is if you are married, you must do a married filing joint return or you're not allowed to take the deduction at all. Another one of the campaign promises was no tips on overtime. So effective for 2025 through 2028 only, for qualified overtime pay, you are allowed to take a deduction. This would be the half portion of the time and a half. So if you make $10 an hour and you have a $15 an hour overtime pay, only that extra $5 counts towards this. It will be reported on the W-2, and it's a maximum annual deduction of $12,500 or $25,000 for a joint filer. Again, this one phases out at a certain range at $150 for individuals and $300 for joint filers. This deduction again is available whether or not you itemize or take the standard deduction. And this is another one that if you are married, you must file married filing joint in order to take the deduction. No tax on car interest loans. This again is a temporary one that's only effective from 25 through 28. The individual can deduct up to $10,000 of interest paid on a vehicle loan. However, that vehicle has to have been purchased after December 31st, 24. It must be a new vehicle that's personal use, cannot be business use, and the use must start with the taxpayer, so you cannot get a used vehicle. It has to be secured by the loan, and the vehicle type has to be a car, minivan, van, SUV, pickup truck, or motorcycle that has gross vehicle weight of less than 14,000 pounds, and it has to have undergone its final assembly in the United States. And you're able to determine this by looking at the VIN, the label information, or by looking at the plant of manufacture reported on the VIN. If you have this loan and you end up refinancing it, generally, if it qualified, it continues to qualify for the deduction after it's refinanced. This one again has a phase out, but it starts at $100,000 and $200,000 for joint filers. And this one is available whether you itemize or take the standard deduction. One of the last campaign promises here is the no tax on Social Security. There's a new deduction effective for 25 through 28 only. It's an additional standard deduction of $6,000 per individual if you're over 65 at the end of the year. If you're married and both spouses qualify, it's a total $12,000 deduction. This one phases out at a much lower rate, $75 for an individual, $150 for joint filers. It's deductible whether you itemize or take the standard deduction. Interesting thing is you don't have to have Social Security in order to get this deduction. You just have to be over age 65. And again, this is one, if you are a married couple, you must file a married filing joint return in order to take any of the deduction. So some other changes are talking about talking about charitable donations. Starting in 2026, it made permanent the 60% AGI limit. And it also enacted a new minimum deduction that you can take. You get $1,000 or $2,000 married filing joint deduction as an above the line for non-itemizers. For somebody who itemizes, there's a new limit of 0.5% of AGI where you can only take contributions over that amount. And the tax benefit for all itemized deductions is now capped for higher income earners, which if you're in the 37% tax bracket, this applies, which basically says that you are only going to get 35% benefit for this instead of 37%. So the way that's calculated is the itemized deductions are reduced by 2/37 of your adjusted gross income, which essentially ends up meaning if you do a $1 donation, you're only going to get 35-cent tax savings versus 37% tax or 37 cents tax savings. And as of 26, this new carryover is subject to that 0.5% floor. So if you have income or deductions that are way over this limit, you actually can carry forward those deductions to future years. So since we have these new donation rules enacted, what can we do to try and, the donation examples for non-itemizer, if you have a $1,000 deduction, an example would be if you have $1,500 that you do as a donation, you're allowed to take $1,000 as an above the line deduction. The additional $500 is lost. If you itemize, there's a 60% AGI limit. So an example, a taxpayer that makes $100,000 could potentially deduct up to $60,000 in the past, but now you have to reduce it by the 0.5% floor. The 0.5% floor example starting in 26, taxpayers that make $200,000 in AGI an itemized $1,500 donation will only get $500 of that donation because that first $1,000 was excluded due to the 0.5% floor. And then overall, the limit is 2/37 of itemized deductions if, again, you're over the highest tax bracket in the 37%. So now some examples of what we can do in order to get the most charitable donations. Consider accelerating those donations into 2025 if you were going to do large ones so that you can get the bigger impact. Consider a donor advised fund contribution. These are investment accounts that are set up specifically to make charitable donations where you get the deduction in the year you make the contribution to the donor advised fund. However, then you can divvy out those funds whenever you would like, the year you donate, the following year, or years in the future. You can combine several years' donations into 1 year if you're going to look at the 2026 going forward to try and exceed that 0.5% AGI limit. You could also consider donating depreciated securities. This helps you to avoid tax on the gain of those increased values and also gives you a deduction at fair market value. And if you're over 70 and a half and you have IRAs, consider doing qualified charitable distributions from your IRA. This completely avoids tax on the IRA distribution, and it gives a full deduction for the charitable donation because it's reducing the taxable amount of the IRA versus having to flow through your itemized deductions. We have a poll very quickly. If you could all take a chance and answer that question, that would be helpful. It helps us to determine that you're here and give you CPE, plus helps us to make decisions on future webinars. Some additional changes. There's now an educational choice for Children's Act credit. This doesn't start until 2027. It's a non-refundable credit up to $1,700 if you make contributions to scholarship granting organizations, which go to K through 12 students. The donation must go to a qualified state authorized SOG to be eligible, and every state has to individually opt in to participate in the credit. You can't take both a credit and a deduction for these contributions, but a credit is always better. Estate and gift tax changes. So this made permanent the increases that we had to the estate tax exemptions. For 2025, it's $13.99 million for an individual and $27.98 million for couples. Starting in 2026, it goes to $15 million and $30 million, and then will be indexed going forward. It has portability for surviving spouses, which means if one of the spouses dies and does not use their full exemption, it will roll to the surviving spouse so that they can get that full $30 million exemption. And the tax rate remains the same. Any income over the exemption will be taxed at 40%. The gift tax exemptions continue to rise, $19,000 per person, $38,000 per couple. It's unlimited gifts between U.S. citizen spouses. If you have one spouse that's a U.S. citizen and one that's a non-U.S. citizen, for 25, you can give $190,000, and for 26, $194,000 without incurring any gift tax issues. There's been some changes to capital gains. Section 1202, which is qualified small business stock sales. There's been some increases here. This is only for somebody who owns a C corporation that has gross assets over $50 million. I'm sorry, less than $50 million, and starting after the enactment of this bill, 7/24/25, $75 million. If you hold it at least 5 years, you don't have to pay tax on the gain. You must be actively engaged in the business. It excludes certain industries like banking, insurance, leasing, farming, mining, personal services like law, accounting, and health services. It provides a new tiered tax structure. If you hold it for 3 years, you can get a 50% exclusion. If you hold it for 4 years, a 75% exclusion. And if you hold it for 5 or more, you get 100% gain exclusion. Also under the new law, it created Section 1062 farmland sales. So starting in 2026, income from the sale of qualified farm property can be put as a 4-year installment payment to the IRS versus having to pay the tax all in the year that it's incurred. There's also enhancements to qualified opportunity zones. The qualified opportunity zones offer you an incentive to put money into distressed communities. The IRS specifically lists where they are. You can defer capital gains by purchasing the qualified opportunity zones. They were set to expire in 26, but they're now going to be extended permanently. So there's special rules if you purchase in 27 or after. However, if you already invested in the qualified opportunity zone, it will still expire in 26 and you have to pay tax on the gain in that year. There's been lots of talk about the health insurance premium assistance credit. As Nick mentioned earlier, there's going to be some potential tax law changes because this is a point of contention due to its expiring and changes. For years after December 31st of 25, it's now limited to lawfully present aliens and any of those that have household income less than 100% of the federal poverty level and are ineligible for Medicare by reason of their alien status are now ineligible for this credit as well. If the liability exceeds the advanced premiums now, it's no longer limited. So all advanced payments that are in excess are subject to the recapture and taxable. And for years starting after December 31st of 27, now they're going to ask for specific information in order to even enroll in the exchange. Things like household income, your immigration status, health coverage, eligibility for coverage, your residency, your family size, and any other information that they deem necessary to confirm that you are qualified. With the bill, there was a lot of credits that were canceled due for the clean energy. As of September 30th, 2025, the clean vehicle credit, the previously owned clean vehicle credit, and the qualified commercial clean vehicle credit are no longer valid. So let's talk about a few federal income tax planning strategies. There's still some above the line deductions that you should keep in mind. Student loan interest up to $2,500 is deductible. There are some phase outs there. The health and savings accounts contributions allow you to make contributions into medical expense accounts where you can then later pay for those expenses and you get a tax deduction for it when you make the contribution. Once you enroll Medicare, you can't make these contributions anymore. It has to be in a high deductible plan. You can put in $4,300 if it's self-only or $8,550 if it's family. And this is a really good retirement planning tool because you can put the funds in each year now and you don't have to use them. You can save them to use for medical expenses in later years. And you can also take a deduction for those or take a distribution for those in later years for expenses that you've already paid once you had the health insurance, health savings account in existence. There is the educator expense where you can take an above line deduction for up to $300. And if you had an alimony agreement that was prior to December 31st of 2018, you are still allowed to take the deduction for those payments. But if it was enacted after that date, you're not allowed to take the deduction. You can always consider IRA contributions. For 2025, you can put $7,000 in, $8,000 if you're 50 or older. These deductions are allowed to be put in up to the due date of the tax return. So you can decide that you want to put an IRA contribution in as long as it's before April 15th. And there are some income restrictions, and you do have to look at whether or not your spouse participates in an employer-sponsored plan to determine if it's deductible. There are some filing status limits for both traditional IRAs and Roth IRAs that we have limited there. Another consideration is a backdoor Roth contribution. A lot of people don't think about this. This is a strategy where if you are over those limits and you aren't able to directly contribute, you can contribute to a regular IRA and then immediately roll it to a Roth IRA, which avoids the tax. Then you have to pick it up on your tax return and report it on a special form to the IRS. One thing that you have to consider is if you already have regular IRAs, you need to exercise caution and don't just jump to do a backdoor Roth. It looks at everything proportionally. So if you have pre-tax and after-tax contributions, there's a special calculation that needs to be done to determine whether or not you can do that conversion without creating any tax. Just a little understanding of a regular IRA versus a Roth IRA. A regular IRA, you put the money in and you can take a deduction for it currently, but you pay tax on it in the future. A Roth IRA, you put the money in, you do not get a current deduction for it, but it grows tax-free and is withdrawn tax-free in the future. So traditional IRAs require you to take a required minimum distribution, currently at age 72, unless you've reached 73 after the date of 12/31/22. Roths do not have that required minimum distribution, so they can be growing tax-free well into your 80s if that's not what you would like to do. Things that you need to consider when determining whether or not you want to do a Roth versus a regular IRA. If you expect that you're going to have a higher tax rate when you retire, then you want to do a Roth IRA. Pay that tax now and get it tax-free later. If you think you're going to have a lower rate when you retire, then you want to take that deduction now where you're getting it at a higher rate and pull it out and pay tax on it at a lower rate. You also should consider putting money into your employer-sponsored plans. You can do pre-tax deferrals into 401ks, 403bs, and some of the plans even offer traditional Roth IRAs as part of the plans. Lastly, we want to talk about gain and loss harvesting. If you already have large capital gains, you might want to consider if you're holding securities or investments in your portfolio that aren't performing well and that have unrecognized losses. You could sell those at this time, get that loss to be able to offset the gain that you have. One of the things that you want to consider is avoiding wash sales. Those losses are disallowed. So that means you can't sell a stock and then buy it back within 30 days. And you want to make sure you're watching the holding period of your securities. Short-term gains are if you only hold the asset for 1 year or less. They're taxed at ordinary rates. So if you have long-term gains, you want to make sure that any of the sales that you're doing are ones that you've held for more than 1 year. And now I believe it's time to turn it over to Nat to talk about business taxes.
Right. Thank you, Kelly. Good morning, everyone. Our first item here is some changes to the Section 179 depreciation deduction for businesses. Coming into 2025, originally, prior to the enactment of 03B, the 179 limit was $1,250,000, with a phase out starting at $3.1 million of qualified asset purchases. The 03B has increased this limit to $2.5 million of potential deductions for qualified asset purchases. And it starts to phase out once you get to $4 million of assets purchased in the tax year, and fully phases out once you get to $6.5 million. So that's quite an increase from where we were. So that should give some businesses that were previously, maybe just over the limitation, the ability to utilize Section 179. There are no changes as far as the type of property that qualifies. We're basically looking at new and used tangible personal property, which also includes off-the-shelf software and qualifying improvements to non-residential real estate. All right, so we have our second poll question. If you could take a moment to address that. This next change is a big one coming into the 2025 tax year. Again, prior to the enactment of 03B, the bonus depreciation rate was down to 40%, which it would have then gone to 20% in 26, and then 0% thereafter. 03B restored the bonus depreciation rate to 100%. Just you have to be careful, though, for assets that were acquired in the first few days of January of 25. The 100% bonus depreciation rate only applies if the asset was acquired after January 19th. If you had something within those first 18 days of the year, you're still subject to the 40% rate for the deduction, but 100% on everything after January 19th. Qualified production property. So this is a new, brand new provision that's really aimed at manufacturing. The congressional intent here was to incentivize investment in domestic production. And what this is, it basically allows taxpayers to qualify to do is, if you're building a new manufacturing facility, and the key word here is a new facility, okay, so new construction, you have the ability to deduct that 100%. Traditionally, those types of real estate investments would have been subject to a 39-year depreciable life. But here we're looking at 100% deduction in the year placed into service. Now there's a lot of stipulations here, but in the right scenario, could be a very significant deduction. The type of property that would qualify are those that are directly part of the production activity. Okay, so and the original use commences with the taxpayer. So again, new construction, and the time period we're looking at is the construction must have begun between January 20th of 2025 and December 31st, 2028. So we have roughly a 3-year window here, and the property must be placed in service by December 31st of 2031. Again, when that property is placed into service, it's 100% deduction. And research and development used for manufacturing activities may also qualify. Now, what's not included here, and again, I think it's important to note, this is a brand new addition to the Internal Revenue Code. There is expected to be a lot of further guidance to come from Treasury on this to really further refine and define, what would qualify. But some things that we know that do not qualify, okay, is if you think about a traditional manufacturing facility, you would have a manufacturing floor, which would be pretty significant portion of the total property, but there may be offices as part of that facility, parking lots, other things that are not directly related to the production process. Those portions of the property would not qualify for the 100% deduction. And also, if you had a manufacturing facility that may also have a retail portion of the building dedicated to the retail function, that also would not be qualified either. Now there is, going back, had stated that this applies to only new construction. There is a used property exception. It's very narrow. So you would have, in certain cases, the ability for the 100% deduction for used property that's acquired between the dates after January 19th of 2025, but before January 1 of 2029. And the stipulation here is that property, so we're basically talking about an existing building. That building could not have been used for any kind of manufacturing or production process between January 1 of 2021 to May 12th of 2025. And you may wonder, well, that's very strange. What's that about? The congressional intent here was really looking at, there may be idle buildings sitting out there that are primed to be retrofitted and rehabbed into manufacturing facilities. So that's what they're getting at here. And it's a pretty narrow opportunity, but you have the right set of circumstances. You could possibly have that 100% deduction if you acquire an existing building. And I think it is also important to note, while there is, this ability for very accelerated depreciation on a piece of commercial real estate used in manufacturing, if that property is eventually sold, that depreciation, that 100% depreciation you took, is recaptured as Section 1245 property. So it's ordinary income versus, traditionally you would have, the sale of a building. It would be a 1250 gain, which is, a capital gain. So you would be paying a higher tax on the back end if the property sold. But if, you're looking at a very long-term hold, the 100% deduction may make sense for you. But if it's, a situation where you may be flipping it around pretty quickly, you may want to think twice about taking that 100% deduction. And also, if you have a change in use within the first 10 years after that facility is placed in the service, and change in use meaning you vacate the property, or it is not used as a manufacturing facility anymore, then the property is treated as though it was disposed, and you would have taxable gain on the depreciation recapture, even though you didn't sell the property. This is another big one, long anticipated. So rewind back to 2022 for businesses that conducted research and development. Again, a lot of that in manufacturing, software development, food and beverage industry type of businesses. In 2022, we needed to start capitalizing those research and development costs and amortizing them over a 5-year period. Now that has, due to the passage of O3B, that is being unwound over primarily the next 2 tax years. So there's 2 ways to go about it. One is if you are a small business, meaning that your 3-year average annual gross receipts are less than $31 million, you can go back and amend your 2022 through 2024 returns and deduct those portions of the R&D expenses that have not been amortized yet. But those amended returns need to be filed by July 4th of 2026. Or, and this applies to everyone. So whether you are a small business or you're a large business, over the $31 million average gross receipts, you're able to take the portion of the capitalized R&D expenses from 22, 23, 24 and deduct those in 2025. And then going forward, for R&D costs in 25 and beyond, you're just expensing those in the year that they're incurred. Or you have the ability to take those 22 through 24 unamortized R&D expenses and deduct them over a 2-year period in 25 and 26. Again, that applies to everyone. So the only piece that applies only to the small taxpayers, the small businesses, is the ability to go back and amend 22 through 24. Everyone else, you'll be dealing with it on your 25 return. And then also important to note, if you have overseas R&D costs, so they're not domestic, they are still continue to be required to be amortized over a 15-year period. All right, and we have our last poll question coming up here. If you could take a look at that, and I'll move on to the changes to the business interest expense limitation. So again, this is a limitation that applies only to large taxpayers. Again, using that same $31 million of average of 3-year average gross receipts. So the change that O3B made was it restored and also makes it permanent, where your adjusted taxable income to determine that 30% of ATI limit is basically a tax basis EBITDA. So prior to this change, you were only able to add back, to your taxable income, the interest expense and tax expense. Now you're able to add back depreciation and amortization. So should give everyone that this applies to a larger basis to apply that 30% to, and hopefully have less interest expense that's limited. The qualified business income deduction. So I know we probably know it by a lot of different names, 199A, the 20% deduction, the pass-through deduction, whatever you call it. This was set to expire at the end of 2025, but the O3B bill made the deduction permanent. And I think it's just worthwhile to pause for a second. And all these things that we say have been made permanent, they're permanent in the sense that they will not sunset, okay? There's no expiration in the law for these provisions to expire, but a future administration or Congress can always come along and pass a different law in the future and make changes to these, what is in the law today as permanent, okay? So the QBI deduction is now permanent. We're not looking at any sunset of that. Again, it's a business calculation, basically 20% of qualified business income. This is pass-through income from an S corporation, a partnership, or a sole proprietor income. So for example, let's say you have $100,000 of income from an S corp, 20% would be a $20,000 deduction. If you're in the 24% tax bracket, that would result in tax savings of $4,800. Now the changes, other than it being made permanent, that were made by O3B is that there's a minimum deduction of $400 for taxpayers that have at least $1,000 of qualified business income. That doesn't start until 2026. And then also starting in 2026, the phase in for the limitation of the wage limit and qualified property limit has increased. So it went from $50,000 for a single filer, $100,000 joint, to $75,000 single, $150,000 for joint filers. So by moving that limitation the phase in for that limitation up a little bit, it will enhance the deduction for those that were maybe in that previous limitation. Currently, in this, we're talking about C corporations. So As of today, in 2025, charitable contributions for C Corps are limited to a 10% of taxable income limit with no floor. Basically, where we're at with O3B is starting in 2026, the charitable contributions need to exceed 1% of the corporation's taxable income and still cannot exceed the 10% of the corporation's taxable income for the year. So basically what this has happened is, just introduced a 1% floor for charitable contributions for a C Corp. Anything over that 10% limitation is still able to be carried forward for 5 years. Employer-provided meals. This could be a little sticky for some. It seems to be targeted primarily at, let's back up a second. For the law today is an employer-provided meal, that the employer provides to an employee, generally deductible at 50%, if provided for the employer's convenience, keeping employees on site and are on the employer's premises. So starting in 2026, that deduction is going to be disallowed. So it's basically a 0% deduction for those employer-provided meals. Now, when you look at it, you think in the sense of like an employer-operated eating facility, like the on-site cafeteria or whatever that may have been providing meals to employees. But it really also applies to, the office coffee and, and office snacks and things like that. So I know that's getting a little in the details, but that's where we are with this provision. So just to summarize, though, things that are unchanged, 50% limitation deduction for meals with clients. If you're out on the road traveling for business purposes, those are still deductible at 50%. And your 100% deduction for the customary holiday party, annual picnic, things like that. Now, getting on to the employer side of the, no tax on overtime, no tax on tips. There are, for 2025, the IRS has basically admitted, hey, it's a transition year, and we don't have time to really go back and change forms and, provide further guidance. So 2025 is going to be a little bit of the Wild West, so to speak. So basically, when it comes to employers reporting to their employees their overtime pay so that they can take the deduction, or their tip and gratuity pay so they can take the deduction for that, the IRS has basically said for 25, it's a transition year. You can determine the amounts by any reasonable method, and there really is no standardized reporting. So whether employers choose to use like box 14, which is that other box on the W-2 to put those items on, they can, or provide some kind of separate statement. There's really no standardized reporting recommended. And but important to note, for 26, there will be standardized reporting. There will be changes to the W-2 forms and 1099s to include those items. And one last reminder for 1099s, 2025, we're still at the threshold of $600. And in 26, that threshold will increase to $2,000 and adjusted for inflation. So 25, though, we're still at that $600 threshold. The FICA tip credit, previously, this really only applied to those in the hospitality industry. think restaurant servers, things of that. Now it's available beginning in 2025 to the beauty service industry. Things like barbershops, hair care, salons, nails, body spa treatments. And that, again, it needs to be a voluntary tip from a customer in order to qualify. There is an employer credit for paid family and medical leave. That was around previously, but it is now made permanent with the passage of O3B. And it's basically a credit that ranges from 12.5% to 25% of the leave that was paid. And the employer can choose to claim the credit based off the wages that were paid to the employee on leave, or the insurance premiums that were paid that provided that that paid leave, if you're using some kind of disability coverage to fund that leave. You just cannot claim the credit on both. And then also, the amount of the credit will reduce your expense deduction for wages or insurance costs. And there are special rules for controlled groups. Lastly, some other tax changes here. The ERC credit, anything that was received for quarter 3 and quarter 4 of 21 that was filed after January 31st of 2024, they will be disallowed. The IRS is not going to process those claims. The statute of limitations was increased to 6 years for those 2 quarters. And there's also enhanced penalties for those aggressive COVID ERC promoters. The clean energy credits being phased out for wind and solar, but remain for geothermal, nuclear, hydrogen type energy. All right. A few quick tips for business owners. Accelerate business deductions if you're a cash basis taxpayer. Prepay expenses before year end. Again, operating expenses, things like inventory that would be required to be capitalized, but not necessarily result. And then increased deductions. Consider paying kids for work performed in the business because of the $15,000 standard deduction. You have the first $15,000 exempt from federal income tax. There are some situations where they're may be excluded from FICA, and those wages may also make them eligible to contribute to a Roth. And also, reminder, retirement plan contributions, anything deferred from employee pay is due by the end of the year. And employer money, contributions, profit sharing, safe harbor match, things like that, those are due with the due date of the tax return, including extensions. If you're buying a building, you may want to look at a cost segregation study to accelerate deductions. If you're in the manufacturing, software development industries, look at the R&D credit. If you're looking to purchase a vehicle and use it 100% for business, vehicles that are over the 6,000 curb weight pound will provide the best depreciation deduction. S-Corp health insurance owners, again, reminder to get that on your W-2 at the end of the year. Make sure you have W-9s for all your subcontractors and service providers, so you have the information for 1099s. And if you have personal use of auto, get that added to your W-2 before the end of the year. And with that, we are right at our end time. We certainly appreciate everyone joining us this morning for your time on this. If you're in the central PA, Maryland area, kind of an ugly winter day, but we thank you for your time. If there's any Q&A that we didn't address, we will certainly follow up with you individually, and hope everyone has a great day.